two different types of cash flow that pretty much every business will experience. There's operational cash flow and there's investment or growth cash flow. Now, for business owners, it's really crucial that you know the difference between these two because they come with their own set of challenges and therefore different solutions too. Now, the way that I use to tell the difference between investment and operational cash flow is to ask two questions. So the first thing is, when you look at the cash flow, both the inflows and the outflows, is this part of a project that will increase your business size or your turnover by more than 10%? And will it take more than 12 months for you to get a return on any money that you spend? Now, if you answer yes to both of these questions, then the chances are you're looking at investment cash flow. Now, if you answer no to both of these questions, probably you might want to consider whether it's a good idea to do this. But if you get at least one yes, one no, then probably chances are you're looking at operational cash flow instead of investment. Now, a very good rule to follow in business is that you want your operational cash flow to be self-sustaining after 24 months of your business being open. So if your business isn't in that position and you're struggling with operational cash flow, then make sure that you check out my other videos or my website because I've got a ton of free help for you on there. If you do want to grow your business and you're looking at spending some money that will take longer than 12 months to make a return on investment, and it will be looking at growing your business by more than 10%, then you are looking at funding your business for growth. And that is what we mean when we're talking about cash flow for investment purposes. And it's fairly reasonable and expected that if you want to grow your business by quite a leap of 10% or more, then your business isn't going to be able to sustain that by itself, and you should expect to have to get some sort of external finance in your business. There's absolutely nothing wrong with that at all, and there is no problem with using debt or any form of external finance to fund your business, particularly when it is for investment purposes. Because at the end of the day, extra plans that you've got to grow your business will put extra demands on your cash flow, and it's really reasonable that you can expect that your business should not be able to fund this without you getting some source of external finance into your business. So before I run over what your options are, just want to pause for a second and tell you about something that I've created that will help ambitious business owners to grow their business. It's called the Profit Cash Growth Assessment. It takes less than 5 minutes to do. It's completely free, and it will give you some pointers on where your blind spots are, and it will give you immediate instant feedback that will help you to improve your financial decision making so that you can increase your profits, improve your cash flow, and ultimately grow your business. So I'll put the link to it in the comments and in the description, and you can also find it on my website too. Okay, so back to your growth plans for growing your business. So assuming that you have identified that it is investment cash flow that you need in your business, and you have done a financial plan and you know exactly where the peaks and troughs in the cash flow will be and what size hole it is that you need to fund. Now, if you've got to the end of that plan and actually you figure out that you have enough cash flow in your business to support it, then that may not actually be a good thing, and this could be a sign that you're generally holding excessive cash in your business. Now, holding excessive cash in your bank account and not reinvesting that money and utilizing that in your business is like having an employee that you keep in a cupboard just in case you need them on a busy day. It's not a very good use of resource in your business, and that is exactly what cash is. Cash is a valuable resource, and you should be using it effectively at all times in your business. Now, particularly in 2024, where we've got inflation of around 5%, if you're not getting a return of at least 5% on that cash, then that cash is actually devaluing. And that is just one reason why holding excessive cash in your bank account is really not a good way of managing your business finances. But that is a video for another day. So back to this video and looking at the 6 methods of how you can use external finance or other people's money to grow your business. So there are loads and loads of different ways that you can get external finance into your business, but there is a reason why I have selected just 6 of them to tell you about, because not all of them are suitable for business growth and some of them are more suited to operational cash flow. So for example, the likes of a business overdraft or a credit card even, or invoice financing. These are all quite flexible finance options where you're only borrowing the amount of money that you need on a monthly basis. So they're very flexible, and the beauty of that is is that it can keep your costs lower if you have temporary cash flow issues. But that does mean that on a long-term basis, these can actually work out more costly. And where you're looking to grow your business and you need funding in your business for a minimum of 12 months, they're actually not very cost effective. And they also come with some risks as well, because the limits are never guaranteed. And therefore, I always recommend that you use one of these 6 methods for funding growth in your business instead. So what are these 6 methods? Well, the first one is business loans, the most obvious and probably the most popular. The second option that you've got is to go and source an equity investor in your business. So that would be where you give away a shareholding of your business to somebody in exchange for cash. Now, they're very elusive, very, very difficult to come by, particularly for small businesses. Now, the next one is vendor finance, and this is quite a modern solution actually. It's gained popularity with the increase in interest rates, but this is where you buy something from normally a third party, so it could be used for buying property or any sort of equipment, but you agree with them to pay them in installments rather than giving them the payment up front. Think of this as like a personal loan. The next one that is suitable for investment growth is business grants. Now, there are loads of business grants out there, but they tend to be in very selective industries. So for example, performing arts, tech and agriculture in particular are some of the industries that have the highest number of grants given to businesses. They're not impossible to get, but they are quite difficult to secure, and they do often come with very strict rules about what you can and can't spend the money on, and that's why they tend to favour investment activities rather than operational activities in your business. So the next source of finance that you can consider for your growth is asset finance. So asset finance generally refers to having a loan to buy a specific asset. So typically this is plant and machinery in your business, and you get a loan for that specific item only, and the loan is secured against that item. So if you have any issues with repaying the loan, then normally it is the item itself that would be taken away from your business in lieu of payment. One of the really good things about asset finance, which is often overlooked by businesses, is that you don't have to get asset finance just to buy something new. You could own equipment already and go and raise asset finance against it. And finally, the 6th option to consider for growing your business is director finance, which is actually one of the most common ways that businesses in the UK fund their growth. And this is where you as the director would put normally your own money into the business. And I've actually done this myself. I've mortgaged my home to fund some of my business opportunities. So it could be a really great way of getting money into your business without having to go and secure external financing from a bank or an investor. So I have done a deep dive on each of these 6 options for you. I've covered off all the pros and cons. I've covered off the tax implications as well, and also how you can go about securing each of them in your business. So make sure you check out the playlist and have a look at all of the different options that you think might be right for funding your business's growth.